Assalamu alaikum warahmatullahi wabarakatuh. Risk management in Islamic finance. Evolution of risk management, all the way to potential challenges of Islamic finance and hedging risk in Islamic finance. We'll go through risk mitigation versus risk management, goals of risk management, and risk of organizational culture. Okay. The goals of financial management is to maximize the value of institutions and defined by its profitability and risk level. The proper business organization must particularly include a suitable and efficient risk management, on which basis the institution has to secure the risk-bearing capacity with sufficient accuracy at all time. Risk management includes the determination of strategies, methods to assess and secure the risk-bearing capacity and implementation of internal control mechanisms, including an internal control system and internal audit. Knowing your business, understanding your risks, ranking your portfolio of risks, quantifying your risk appetite, merge of your risk blueprint with organizational strategy, and establish governance and management structures, build systems and infrastructure, develop policies and procedures is the developmental process of the risk management framework. Different organizations run different risk and have different risk appetite. Just because the organization is in the same industry or uses the same products, services, does not mean it has the same risks and needs. Size does not matter, and the same does not fit all. Some risks are more difficult to manage than others. Thus, the process of assessing the level of importance to each individual organization is necessary. Remember, the risk management is not a part-time activity. It's a dynamic process that must be understood and acted on in virtually every part of the organization. The goal of risk management is to create a situation where staff and management instinctively look at risk and consider their impact when making effective decisions. Thus, risk management is central at the operations of financial institutions, both from business and regulatory perspectives. The profitability and stability of a bank depends on how risk associated with financial actions or financing is managed. Different between risk mitigation and risk management. Risk mitigation, defensive and used to protect institution systems from risk by using instruments like derivatives, hedging, and insurance. Risk management, this relates to using risk to the advantage of the institution by aggressively exploiting uncertainty and risk through various proactive policies that create value. The main steps of the development. Diagnostic gap analysis leads to decisions should the bank have the best practice in all dimensions of this diagnostic or gap analysis. And then it goes from there to the implementation and is analyzed again. The risk management in Islamic banking institutions need to focus on the following categories of risk: the credit risk, the equity investment risk, the market risk, the liquidity risk, the rate of return risk, the operational risk, Sharia non-compliance risk, and fiduciary risk. Besides these risks, Islamic banking institutions are also exposed to reputational risk arising from failures in governance, business strategy, and process. Negative publicity about the IBI's business practice, particularly relating to Sharia non-compliance and their products and services, could have an impact upon their market position, profitability, and liquidity. As a credit risk is generally defined as the potential that counterparty fails to meet the obligations in accordance with the agreed terms, credit risk includes the risk arising in the settlement and clearing of transactions. Equity investment risk pertains to the management of risks inherent to the holding of equity instruments and investment purposes, such as instruments are based on mudaraba and musharaka contracts. The capital invested through mudaraba and musharaka may be used to purchase shares in publicly traded company and privately held equity and invested in specific project portfolio, or through a pooled investment vehicle. In the case of a specific project, may invest in different investment stages. Market risk is defined as the risk of loss of on and off balance sheet positions arising from movements in market prices, i.e., fluctuations in values in tradable, marketable, and leasable assets, including sukuk, and in off balance sheet individual portfolios, the risk relate to the current and future volatility of market values of specific assets. The commodity price of a salam asset, the market value of a sukuk, the market value of a Rabaha asset purchased to be delivered over a specific period, and of foreign exchange rates. In operating ijara, a lessor is exposed to market risk on the residual value of leased asset at a term of the lease, or if the lease terminates the lease earlier by defaulting during the contract. In Idra Muntaya Bidamlik, a lessor is exposed to market risk on the carrying value of leased asset as collateral in the event that the lessee defaults on the lease obligations. Liquidity risk is the potential loss of the IBIs arising from their inability either to meet their obligations or to fund increases in asset as they fall due without incurring unacceptable costs or losses. IBI must have liquidity contingency plan addressing various stages of liquidity crisis, should define the classification of these stages, but may consider differentiating the stages as follows. Identification of a liquidity gap or a situation which acts as a triggering event. Withdrawals do not follow predictable patterns when, for example, the IBIs may suffer an institutional rating downgrade. A need to liquidate assets or investments in an orderly manner to meet such a liquidity gap or situation, and emergency measures to be taken in the event that the previous steps fail to meet the liquidity gap adequately. Where appropriate, IBIs shall include in the contingency plan the following factors and define appropriate action points at each stage: holding the tradable high-quality liquid assets, which may be readily disposed of in seizable amounts in deep markets, taking into account the likelihood that it will not be possible to release full book value, a profile of other assets, and the degree of liquidity of these assets. Assessment of Sharia-compliant and available funding products in the market, including possible cooperation agreements with either the IBIs or conventional institutions on an interest-free basis for assessing temporary funding, or sale and leaseback arrangements for longer-term funding. Possible liquidity arrangements with the central bank on the interest-free basis. Establish a crisis management team or personnel responsible for taking actions at different stages of the liquidity crisis, and notification procedures of communication with IBI's head office or supervisory authorities. However, to the extent of the IBIs intend to rely on the types of cooperation agreements mentioned above, they need to ensure that willing counterparties will exist for such arrangements. IBIs are exposed to rate of return risk in the context of their overall balance sheet exposures. An increase in benchmark rates may result in PLS deposit holders having expectations of a higher rate of return. Interest rate risk of IBIs are concerned with the result of their investment activities in the end of the investment holding period. Such results cannot be predetermined exactly. A consequence of rate of return risk may be displaced commercial risk. IBIs may be under market pressure to pay a return that exceeds the rate that has been earned on assets financed by PLS deposit holders when the return on an asset is underperforming or compared to the competitors' rates. IBIs may decide to waive their rights to part of their entire mudarib share of profits in order to satisfy the retain their funds providers and dissuade them from withdrawing their funds. Displaced commercial risk derives the competitive pressures of IBIs to attract and retain investors, fund providers. IBIs are exposed to risks, failures, internal controls involving processes, people, and systems. The controls should provide reasonable assurance, soundness, and operations of reliability of reporting. IBIs are also exposed to reputational risk arising from failures in governance, business strategy and process. Negative publicity about IBI's business practices, particularly relating to Sharia non-compliance in their products and services, could have an impact upon market position, profitability, and liquidity. IBIs shall consider the full range of material operation risk affecting their operations, including the risk of loss resulting from inadequate or failed internal process, people, and systems from external events. Shall also incorporate possible causes of loss resulting from Sharia non-compliance and the failure in their fiduciary responsibilities. Exposed to risks relating to Sharia non-compliance and risks associated with IBI's fiduciary responsibilities toward different fund providers. These risks expose IBIs to fund providers, withdrawals, loss of income, or voiding of contracts, leading to diminished reputation and limitation of business opportunities. A reliable IT system is a must for profit-sharing mechanism, failure to which may lead to Sharia non-compliance risk. The bank should identify key risk indicators and should place key control activities, the code of conduct, delegation and authority, segregation of duties, succession planning, mandatory leave, staff compensation, recruitment and training, dealing with customers, complaint handling, record keeping, MIS, and physical controls. Sharia non-compliance risk is the risk that arises from IBI's failure to comply with the Sharia rules and principles prescribed in the Sharia advisor of IBIs. Sharia compliance is critical to IBIs. Operation and such compliance requirements must permeate throughout the organization and their products and activities, as majority of the fund providers use Sharia-compliant banking services as a matter of principle. Their perception regarding Islamic banking institutions' compliance with Sharia rules and principles is of great importance in the sustainability of IBIs. In the regard, Sharia compliance is considered as falling within a higher priority category in relation to other identified risks. IBIs shall ensure that they comply at all times with the Sharia rules and principles as advised by the Sharia advisor as well as the SBP with respect to their products and activities. This means that Sharia compliance considerations are taken into account whenever the IBIs accept deposits and investment funds, provide finance, and carry out investment services for their customers. They shall that their contract documentation complies with Sharia rules and principles with regard to formation, termination, and elements possibly affecting contract performance, such as fraud, misrepresentation, duress, or any other rights and obligations, shall undertake Sharia compliance review at least annually, performed either by a separate Sharia audit, departmental, or as part of the existing internal audit function by persons having the required knowledge and expertise for the purpose. The objective is to ensure that the nature of the IBI's financing and equity investment and B, the operations are executed in adherence to the applicable Sharia rules, principles as per the fatwa, policies, and procedures approved by IBI's Sharia advisor. IBI shall keep track of income and recognized arising out of Sharia non-compliance and assess the probability of similar cases arising in the future. Based on historical reviews and potential areas of Sharia non-compliance, the IBIs may assess potential profits that cannot be recognized by eligible IBIs profits. Fiduciary risk is the risk that arises from IBI's failure to perform in accordance with the explicit and implicit standards applicable to the fiduciary responsibilities, meet the demands of current account holders for repayment for their funds, and safeguard the interest of the PLS deposit holders. IBI shall adequately disclose information on a timely basis to the PLS deposit holders and markets in order to provide reliable basis for assessing their risk profiles and investment performance, as prescribed by SBP from time to time. Hedging risk in Islamic finance. Murabaha multi-factor risk matrix is a pretty good setup to explain it. It's a risk factor of agency risk is a category credit risk, and the hedging is direct payment to the vendor and proper pre-inspection. Pause the video here and read this chart, and you'll get to know it pretty well. Musharaka multi-factor risk matrix is another that has capital risk as a credit risk. This can be mitigated by conducting extensive feasibility study prior to entry. For example, of hedging. Diminishing Musharaka multi-factor risk matrix. There's a lot of different risks to be acquainted with. Salam multi-factor risk matrix. Sukuk multi-factor risk matrix. Istisna multi-factor risk matrix. Ijara multi-factor risk matrix. Again, pause this video and go through them. These matrices are very helpful for learning the different risks and how to assess them with hedging. Its potential challenges for Islamic finance. Potential challenges for Islamic finance. Questions? In the comments, remember to comment, rate, and subscribe. Like this video.